This is chapter 12, the first part of chapter 12, and we're going to be talking about estimating cash flows. So the first thing we're going to do is a pro forma analysis. Now this chapter has to do a lot with accounting. I'm not going to go into it in great detail. However, I think it's important for you to understand where our numbers are coming from, especially for chapter 13. This is the explanation. This justifies where are our numbers coming from in chapter 13, and that's why I want you to remember. So, perform analysis, we basically try to come up with our best estimate on what's going to happen in the future, right? Uh, it's basically what our numbers that we're going to be having, and one of the main important things is we're working with incremental cash flows. Incremental cash flows. If we decide to take a new project, we will be using more money and we will be receiving more money. So that additional money that we're receiving, the additional money that we are paying, that's the incremental cash flow, right? That's the incremental cash flow, right? So, well, that's basically what I was saying, right? Now, we need to think about opportunity costs. If we invest in a new project, we will be losing money from other sources, right? Let's say we have an empty lot in downtown and we have a parking lot, right? And we charge parking. If we decide to build a building, well, we're going to be losing that money that we were receiving from parking, right? That is a cost. Now, hopefully, whatever we do is going to give us more money than our parking lot, but we need to take that into account. There are also sunk costs, right? Think about the CEO salary, for instance, or office rent. You're going to have to pay that whether you decide to take the project or whether you don't decide to take the project. Those costs will be there regardless. So those are called sunk costs. We cannot get rid of them, but on the other hand, they are not part of our incremental cash flow analysis. They will never be part of our incremental cash flow analysis. Now, we also need to think about substitution and complements, right? Some of our new projects are going to be substitute of old ones. Some of them are going to be complements, right? Uh, think of the iPhone. The iPhone is a very good example. Every time there's a new iPhone, that new iPhone is a substitute of the old iPhone, right? So Apple needs to think that the sales of their old iPhone are going to go down and the sales of the new iPhone are going to go up. That is how it works, right? Both devices are substitutes. Now, think about the Apple Store on the other hand, the App Store. If there are more and more iPhones, regardless on which model, chances are that more people are going to consume from the App Store, right? So the App Store is a complement of the iPhone, right? So as the sales of the iPhone go up, sales in the App Store go up. Right? Different iPhones are substitutes. Sorry, if the new iPhone goes up, the old iPhone goes down, right? Uh, Now, when we're thinking about the project's cash flow, so pretty much how much money are we receiving from the project? There are several aspects we need to take into account. Depreciation being the first one, the loss in value of our assets. Uh, that has an effect on our cash flow. Operating cash flow, well, it's basically the cash flow that we get from running the firm. Changes in gross fixed assets. That is basically whether we acquire new assets or we sell them. And net working capital. Net working capital is current assets minus current liabilities. Sometimes at the beginning of new projects, we need to increase the net working capital. So let's talk a little bit about depreciation, right? First of all, and hopefully you remember this from accounting, depreciation is the loss and the value of the assets. What is included in depreciation? Well, obviously the cost of the asset, amounts, such as sales tax, fried, if there's transportation cost, that's also included in depreciation, and installation and testing. So basically all of the expenses related to our acquiring the new asset. This is the easiest method, straight line. So pretty much the basis, how much are we going to depreciate minus the end book value divided by the number of years, right? That's the simplest method in order for us to calculate depreciation. Now, the operating cash flow. It's basically the earnings before interest and taxes times 1 minus the tax rate plus depreciation, right? So it's basically the earnings before interest, right? 1 minus the tax rate, we're